Most people think paying off a house ends financial stress. And the truth? A mortgage-free home can quietly make you poor, lock your wealth, and limit flexibility. Without liquidity, diversified income, and optionality, your safe house can become a trap. Discover why true financial security isn't ownership, it's control. For most adults, taking on a mortgage feels like entering the next stage of financial maturity. It represents stability, commitment, and long-term planning. Unlike rent, which feels temporary and unrewarding, a mortgage carries the promise of ownership. Each payment appears to move you closer to something permanent. Over time, that sense of movement creates a powerful psychological reinforcement. You're not just spending money, you are building equity. You are progressing. But progress and activity are not the same thing. A mortgage is structured to feel productive. You make consistent payments. Your balance gradually declines. Statements show principal reductions. The numbers change in your favor, slowly but visibly. This incremental shift provides emotional comfort. It tells a story of advancement. Yet beneath that story lies a financial structure designed less for wealth creation and more for debt servicing over time. The core issue is not the existence of interest. Interest is simply the cost of borrowing money. The deeper issue is how long that cost compounds and how it shapes cash flow behavior. In a traditional long-term mortgage, particularly a 20 or 30-year structure, the early years are dominated by interest payments. The majority of each monthly payment does not increase ownership in any meaningful way. It compensates the lender for time. Time, in this context, is expensive. When you stretch a purchase over decades, you're not just spreading payments, or multiplying total cost. A home priced at $350,000 rarely costs $350,000 by the time the loan ends. Once interest is accounted for, the final amount paid can be hundreds of thousands more. This difference is often acknowledged, but rarely internalized. People focus on the monthly payment because that is what affects their daily budgeting. The lifetime cost remains abstract. Abstraction is dangerous in finance. Humans respond strongly to immediate pressure, but weakly to distant consequences. A mortgage leverages this bias. It converts a large upfront expense into manageable installments. The installments feel reasonable. They fit within income constraints. They create the impression of affordability. However, affordability measured monthly can obscure inefficiency measured over decades. There is also an opportunity cost embedded within every mortgage payment. The portion allocated to interest is capital that will never return to you. It does not build liquidity. It does not generate income. It does not compound in your favor. Instead, it exits your financial system permanently. Over time, that consistent outflow reduces the amount available for investment, skill development, or alternative income creation. The trade-off is rarely calculated explicitly. It is simply accepted as normal. Normalization is what makes the mortgage powerful. Because nearly everyone participates in the same system, it rarely feels questionable. Social proof reinforces the structure. Buying a home with borrowed money is not viewed as risky behavior. It is viewed as responsible adulthood. Yet responsibility should be measured by efficiency and resilience, not by conformity. The mortgage also reshapes risk perception. Once approved for a loan, individuals often anchor their financial decisions around that obligation. Career moves, entrepreneurial risks, and relocation choices become filtered through the need to maintain consistent income. The debt does not merely cost money, it narrows flexibility. Over time, this narrowing can slow wealth accumulation indirectly by discouraging higher risk, higher reward opportunities. None of this means mortgages are inherently destructive. They are tools. But tools have structural consequences. A long-term mortgage trades short-term access for long-term cost. It trades liquidity for stability. It trades flexibility for predictability. These exchanges are not always harmful, but they are rarely neutral. The illusion of progress emerges because paying down debt feels productive. Watching a balance shrink feels like building something. Yet true wealth is not measured solely by debt reduction. It is measured by the growth of assets that produce income or appreciate independently of ongoing payments. If most financial energy is directed towards servicing a loan, asset growth may lag behind perception. The mortgage feels like forward motion. In reality, much of that motion is circular. Money enters your account, exits toward the lender, and builds wealth elsewhere. Understanding this distinction is the first step toward recognizing how a mortgage can quietly reduce long-term financial potential without ever feeling like a mistake. The financial cost of a mortgage is visible on paper. Interest rates, amortization schedules, and total repayment amounts can all be calculated with precision. The psychological cost, however, is harder to measure and far more influential. A long-term mortgage does not simply alter cash flow. It reshapes behavior, risk tolerance, and decision-making patterns in ways that compound quietly over time. Debt creates obligation, and obligation creates constraint. Even when payments are affordable, the knowledge that they must be made every month for decades introduces a background pressure. This pressure does not always feel intense. In fact, It often fades into routine, but routine obligations influence how people evaluate uncertainty. When a fixed expense dominates the household budget, stability becomes the primary objective. Income security takes precedence over growth potential. Predictability becomes more valuable than upside. This shift may appear responsible, and in many cases it is. However, long-term wealth accumulation often requires calculated risk. Career advancement frequently involves relocation, skill reinvestment, or temporary income volatility. Entrepreneurship demands flexibility and tolerance for uncertainty. A mortgage narrows that tolerance. The larger the payment relative to income, the stronger the pull towards safety. Over time, this changes financial behavior in subtle ways. Individuals may remain in roles that no longer align with their strengths simply because the income is reliable. They may avoid geographic moves that could increase earning power because selling and repurchasing property introduces friction. They may delay investment in new skills or ventures because liquidity feels scarce. The mortgage does not force these choices explicitly. Instead, it creates an environment where caution feels rational and deviation feels risky. There's also a cognitive anchoring effect. Once a person commits to a large debt, their perception of financial stability adjusts around it. The payment becomes normal. Other expenses are evaluated relative to it. If the mortgage consumes a significant portion of income, remaining funds are often viewed as limited discretionary space rather than growth capital. Investment contributions, business experimentation, or aggressive saving can begin to feel optional rather than essential. Another psychological dimension involves the concept of sunk cost. As years pass and significant interest has already been paid, homeowners often double down on the commitment. Selling can feel like abandoning progress, even if a move would improve financial positioning. The emotional weight of past payments discourages change. The longer the timeline, the stronger the attachment. What began as a financial arrangement becomes an identity marker. Stability becomes intertwined with ownership. This identity reinforcement matters. When homeownership is treated as proof of responsibility or adulthood, questioning its structure can feel like questioning personal competence. As a result, inefficiencies persist unexamined. Few people regularly reassess whether their mortgage structure aligns with broader financial goals. The loan is signed, automated, and mentally categorized as resolved. Attention shifts elsewhere, even though the obligation continues shaping every future decision. The mortgage also influences how emergencies are perceived. With a large fixed cost in place, unexpected income disruptions become more threatening. This increases stress sensitivity. Instead of viewing financial setbacks as temporary obstacles, individuals may interpret them as systemic threats. The psychological burden of maintaining housing stability amplifies ordinary volatility. Even when adequate savings exist, the fear of default can influence behavior. Furthermore, the presence of long-term debt alters time horizons. Because the loan stretches across decades, people subconsciously adopt similar planning cycles. They think in terms of after the house is paid off rather than in terms of incremental wealth-building milestones. This deferral mindset postpones more dynamic financial strategies. Growth is delayed in favor of endurance. The most subtle effect is normalization of leverage. Once comfortable carrying a large mortgage, additional debt can seem less alarming. Car loans, renovations, and lifestyle upgrades feel manageable in comparison. The psychological barrier to borrowing lowers because substantial debt is already integrated into life. This cumulative leverage increases fragility without feeling proportionally risky. In isolation, each of these behavioral shifts may appear minor. Over years, however, they accumulate. The mortgage does not merely cost interest. It redirects ambition toward preservation rather than expansion. It encourages stability over adaptability. It prioritizes consistency over optionality. These are not inherently negative values, but when overemphasized, they can suppress long-term financial velocity. Understanding the psychological dimension of mortgage debt reveals why its impact extends beyond mathematics. The obligation shapes perception, and perception shapes action. And when flexibility narrows gradually, the cost is rarely noticed in the moment. It becomes visible only in hindsight, when opportunities that once seemed possible were quietly declined in favor of maintaining the structure. The most misunderstood aspect of a mortgage is not the interest rate. It is the direction of compounding. Compounding is often described as the engine of wealth, but its power depends entirely on who benefits from it. When money is invested, compounding works in your favor. When money is borrowed, compounding works in favor of the lender. A long-term mortgage places you on the paying side of that equation for decades. In the early stages of a mortgage, interest dominates the payment structure. Even at moderate rates, the amortization schedule ensures that a significant portion of each payment goes toward interest rather than principal. This means that, for years, your cash flow is not materially increasing your ownership position. It is compensating the bank for the passage of time. Meanwhile, the funds directed toward interest cannot participate in market growth, business development, or alternative asset accumulation. This is where the unseen compounding effect begins. When capital is consistently diverted away from productive assets, growth slows, not abruptly, but steadily. Consider the difference between allocating an additional monthly amount toward accelerated mortgage payments versus investing that same amount into diversified assets over 20 or 30 years. The investment scenario benefits from reinvested returns. The mortgage acceleration scenario eliminates interest expense, but does not generate external yield. The comparison is not always simple, but it reveals a structural trade-off: certainty versus expansion. The opportunity cost becomes more pronounced over longer time horizons. Early and mid-career years are typically the most powerful for compounding because time amplifies growth. Money invested at age 30 has decades to expand. Money invested at age 50 has far less runway. When a large share of disposable income is consistently absorbed by housing costs during prime compounding years, the long-term portfolio may grow more slowly than expected. The difference may not be visible in any single year. Over decades, it can become substantial. Another overlooked factor is inflation. Inflation reduces the real burden of fixed-rate debt over time, meaning that a mortgage payment becomes relatively cheaper in inflation-adjusted terms as years pass. At the same time, assets that appreciate or generate income may rise with inflation. When homeowners aggressively prioritize eliminating low-rate fixed debt instead of investing in appreciating or income-producing assets, they may unintentionally reduce their inflation advantage. The mortgage, while costly in nominal terms, can be strategically neutral or even beneficial when balanced against productive investment. Liquidity also plays a central role in compounding dynamics. Wealth is not only about total net worth, it is about the capacity to deploy capital when opportunities arise. A mortgage-heavy financial structure reduces deployable capital. When most available funds are tied to mandatory housing payments, fewer resources remain to seize undervalued investments, pivot careers, or fund new ventures. The compounding of missed opportunities is difficult to measure, but its effect is cumulative. Each missed investment does not only represent a single lost return, it represents the loss of returns on future returns. Risk concentration further amplifies the issue. A primary residence is typically a single asset in a single geographic market. Its performance depends on local economic conditions, demographic trends, and regulatory factors. Unlike diversified portfolios, which spread risk across industries and regions, housing concentrates exposure. When large amounts of capital are funneled into accelerating mortgage payoff or maintaining high housing costs, diversification can suffer. Compounding thrives on breadth and reinvestment. Concentration limits both. There is also the behavioral compounding effect of comfort. As homeowners grow accustomed to steady payments and gradual equity accumulation, the urgency to pursue higher return strategies can diminish. Stability becomes satisfying enough. Over time, financial ambition may recalibrate downward. This is not inherently negative, but it does influence total wealth trajectory. Incremental comfort can reduce incentive for strategic risk-taking, and reduced risk-taking can limit exponential growth potential. Importantly, none of this suggests that housing is inherently a poor financial decision. Shelter is essential, and ownership can provide stability and personal satisfaction. The issue arises when the mortgage absorbs disproportionate financial energy. When the majority of income growth is directed toward maintaining or accelerating debt repayment rather than expanding productive assets, compounding shifts direction. The compounding effect you do not see is the silent comparison between what is happening and what could have happened. Every dollar servicing long-term debt is a dollar not compounding for you. Over time, that directional difference matters more than most homeowners realize. A paid-off house is often celebrated as the ultimate symbol of financial achievement. The mortgage is gone. Debt no longer dictates monthly decisions. Psychologically, this milestone provides a sense of security, yet the security can carry an unexpected cost. Once the obligation of repayment is removed, the perception of risk diminishes, but actual risk does not. The house remains a static, illiquid asset that demands ongoing resources and attention. What feels like freedom can quietly become a constraint. The first dimension of this constraint is liquidity. While a mortgage is an ongoing expense, it also forces individuals to maintain cash discipline. Monthly obligations encourage reserve accumulation, careful budgeting, and regular assessment of financial priorities. When the mortgage disappears, this structural pressure fades. There is no longer an enforced need to maintain disciplined liquidity. Many homeowners respond by increasing discretionary spending, adopting lifestyle upgrades, or deferring savings in areas that once felt urgent. The result is a shift from enforced financial discipline to a more subjective, emotion-driven decision framework. Maintenance and unexpected costs present another challenge. A mortgage does not eliminate these expenses. It simply places them in a broader context. Without debt, property taxes, insurance, and repair costs may feel manageable. But these obligations persist, and they are often irregular and unpredictable. A major roof replacement, foundation repair, or emergency plumbing issue can arrive with little warning. Homeowners accustomed to predictable monthly payments may underestimate the potential impact of these lump sum costs on cash flow. In other words, the absence of debt can create a false sense of preparedness, leading to underestimation of real financial vulnerability. Psychological attachment adds another layer. Once a house is paid off, it often transforms from a shelter into a symbol of discipline, sacrifice, and success. Emotional investment grows alongside financial investment. The house becomes untouchable. Selling it can feel like failure. Relocating can feel like regression. Even when alternatives such as downsizing or reallocating capital are objectively beneficial, homeowners may resist because of the psychological weight attached to the asset. This attachment can limit flexibility in the face of changing circumstances, effectively turning security into a constraint. Concentration risk is also significant. A paid-off house concentrates a large portion of net worth in a single non-liquid asset. Unlike a diversified portfolio, this concentration cannot be adjusted incrementally. Any attempt to extract capital involves selling the asset or leveraging it through borrowing, both of which introduce costs, friction, and potential risk. When most of a household's financial security is tied to a single property, the ability to respond to financial shocks diminishes. The very asset intended to provide safety can therefore reduce adaptability, particularly in the face of income volatility, health crises, or unexpected expenses. The combination of perceived safety and actual constraint leads to behavioral consequences. Homeowners may remain geographically anchored, delaying relocation opportunities or career changes. They may prioritize preserving the asset over pursuing growth opportunities, such as investments or entrepreneurship. They may adopt a more conservative lifestyle, avoiding calculated risks that would otherwise enhance financial resilience. Over time, the house, intended as a foundation of stability, becomes a gravitational center around which all financial and life decisions revolve. This gravitational pull is subtle but powerful. It is the quiet constraint that accompanies the perception of freedom. Inflation further complicates matters. While a mortgage payment is fixed and predictable, the cost of living, utilities, and unexpected expenses increase over time. A paid-off home does not grow cash flow or protect against rising costs. When a large portion of wealth is illiquid, rising expenses can erode flexibility and exacerbate stress. Homeowners may perceive themselves as secure, but their ability to respond to economic changes is limited. The rigidity of the asset can produce fragility, particularly when flexibility is most needed. Finally, optionality, the ability to pivot in response to new opportunities, is diminished. True financial security is defined not by the absence of debt, but by the capacity to absorb shocks and exploit advantages. A house alone cannot achieve this. It provides shelter, stability, and a sense of accomplishment, but it does not inherently enable adaptation. The removal of mortgage obligations may create psychological relief, but without liquidity, diversification, and multiple income streams, it can reduce rather than enhance overall financial resilience. The paradox is clear. The very milestone that is celebrated as the pinnacle of financial security can, in isolation, introduce new limitations. A house, when treated as the foundation of security rather than a component of a broader financial system, can restrict movement, reduce flexibility, and concentrate risk. Security, in this sense, is not a function of ownership alone. It is a function of adaptability. In the next chapter, we will examine how to construct a system in which a home enhances safety rather than restricting it, and how true financial resilience is achieved through structure, not symbolism. By now, it should be clear that a paid-off house, while emotionally satisfying, is not synonymous with financial security. Owning a home outright provides shelter and a sense of accomplishment, but true safety is not about possessions. It is about control, flexibility, and the ability to respond to life's uncertainties without panic. Financial resilience is not a milestone. It is a system, a continuous state of adaptability that allows you to navigate volatility while preserving options. The first pillar of this system is liquidity. Accessible cash is the foundation of resilience. It allows you to handle emergencies, cover unexpected expenses, and take advantage of opportunities without destabilizing other parts of your financial life. Liquidity is not about hoarding money for its own sake. It is about creating breathing room. When your wealth is concentrated in a single illiquid asset, such as a paid-off house, the absence of accessible capital can turn perceived freedom into silent vulnerability. Substantial net worth becomes fragile if it cannot be deployed when needed. The second pillar is diversified income. Relying solely on a salary or a single source of wealth creates fragility. True security comes from multiple streams of income, earned income, investment returns, and skills that can be monetized in various contexts. Diversification is not just about financial assets. It is about flexibility in how you generate and deploy resources. By spreading sources of income, you reduce dependence on any single factor and enhance your capacity to respond to shocks, whether they arise from career changes, market volatility, or personal circumstances. Optionality is the third pillar. Optionality is the ability to make decisions without constraint, to pivot without fear of catastrophic consequences. It includes the freedom to change jobs, relocate, downsize, or invest in new ventures. A home can support optionality if it is part of a larger adaptive system. But if the home represents the bulk of wealth or defines the limits of financial flexibility, it becomes a constraint. True financial safety is measured not by the size of your assets, but by the breadth of choices those assets enable. The fourth pillar is deliberate expense management. Low fixed costs and predictable obligations create resilience. Expenses that do not scale unnecessarily with lifestyle provide flexibility. Some renters, for example, maintain stronger financial safety than homeowners because their commitments are smaller, adjustable, and responsive to changing circumstances. Security is less about what you own and more about how much of your future income is pre-allocated. Preserving optionality requires maintaining manageable obligations. Finally, psychological safety completes the system. True security is not only mathematical, it is emotional. It is the confidence that a single setback will not derail your life. It is the absence of chronic stress over money. It is the assurance that mistakes, unexpected costs, or temporary income disruptions are manageable. Psychological safety is cultivated through planning, redundancy, and flexible structures, not by a single completed milestone. When these pillars are in place, a home becomes an asset rather than an anchor. It provides stability, shelter, and potential appreciation, but it no longer dictates choices or constrains action. The difference is systemic rather than symbolic. Wealth and security are not achieved by eliminating one liability. They are achieved by building a framework capable of absorbing shocks, leveraging opportunities, and maintaining adaptability over time. The lesson is clear. The paid-off house is a tool, not the destination. It should exist within a broader system designed for flexibility, diversification, and optionality. Financial security does not reside in the absence of debt alone. It resides in the presence of structure. If a home is the only pillar supporting perceived safety, that security is fragile. If a home is part of a resilient system, it enhances freedom and amplifies stability. Understanding this distinction is essential. Ownership without systems creates rigidity. Systems without ownership create adaptability. True safety occurs when both coexist. A home that provides shelter and stability, integrated into a financial framework that provides flexibility, liquidity, and psychological confidence. When these elements align, a paid-off house contributes to resilience rather than restricting it. Security is no longer an illusion. It becomes actionable, reliable, and sustainable. The ultimate insight is that money and assets serve life, not the reverse. A home can symbolize achievement, but real freedom arises from control over resources, optionality in decisions, and the ability to navigate uncertainty. By building a system rather than chasing milestones, homeowners transform security from a static state into a dynamic advantage. This is the structure that converts the psychological comfort of a paid-off house into enduring financial resilience.